Folks, welcome to the macro setup. I'm Guy Adami. I'm here with my dear friend Dan Nathan. Dan Nathan, very casual today. Love the outfit. He's got the whole vest thing going on. This macro setup is brought to you by IG, one of the fastest growing Forex exchanges in North America. By the way, we're going to have a special guest about midway through. Peter Hanks, a strategist at Daily FX, is going to be with us. We loved him in Toy Story, better in Forrest Gump. He's going to be even better today. Dan, welcome.
Well, listen, I appreciate you kind of recognizing my casual look. It's a pre-holiday look, Guy. We're in a holiday shortened week, but I always find these weeks, like Thanksgiving week with Black Friday, take it to the bank. As long as I've been in this business, there's been some weird price action. It has a lot to do, I think, sometimes, and maybe like poor liquidity. Maybe when the mice is away or the cat will play or whatever. I think I got that backwards there.
Yeah,
I
got you.
Yeah, you saw what I was doing there. But I guess the point is that, like, listen, we got off to a rip-roaring start this week for some of the usual reasons, especially in the S&P 500. But some of the things that we might kind of get into later in this week when liquidity kind of dries up a little bit might just have to do with a kind of FOMO sort of rally here, because some of the headwinds that have been holding back the market have kind of abated this week.
Yeah, what's amazing, though, you say holding back the market, and to a certain extent, you're right. Clearly, the price action suggests that, but it's not like the market was getting obliterated on the back of some of these things. I mean, the fact that President Trump, listen, it appears as though, and I say appears because a lot can change, obviously, from day to day, but appears as though there's some sort of concession and there's going to be a transfer of power. At least that's what the market is perceiving. I think also a lot of this rally is predicated on the fact that it appears as though Janet Yellen's going to be our next Treasury Secretary, the first woman to hold that office. I think the market really likes that. I think in large part because Janet Yellen to the market is a lot better than the opposite side of that coin, which could have potentially been an Elizabeth Warren. So the market's viewing everything through the lens of bullish, bullish, bullish. That's great. We're going to talk about the VIX later. We're going to talk about, obviously, the dollar and gold later. But right now, it's all systems go in terms of the broader market, in terms of some of this rotation that's been playing out over the last couple of weeks, Dan.
Yeah, it's funny. You use the term appearance as it relates to the election, and that's one of the reasons why I'm saying there's a bit of a FOMO, because I think to most observers, there wasn't the appearance that Biden won. Biden won. You know what I mean? Like that was fairly well confirmed a couple weeks ago now. It's just that the fact is the outgoing lame duck administration has called it into question. That doesn't change the fact that Joe Biden, the president-elect, is going to be nominating or naming his nominations for cabinet positions that will have an effect on the market. I think, you mentioned the one about Yellen yesterday, obviously the former Fed chair. And what I think, you say the market likes it. I think they like the fact, what is the current Fed chair been asking the White House and Congress and Treasury to do to implement more fiscal stimulus? We haven't had any since March. And we know that we still have, somewhere of 20 million U.S. citizens that are getting some form of unemployment. But those unemployment benefits have actually declined over the last 3-4 months or so. So we're getting to a long stretch where the Fed has wanted more fiscal stimulus added to the monetary stimulus. The fact that Janet Yellen will now, or at some point in the next few months, be named the Treasury Secretary, the assumption here is that the Fed and the Treasury are going to work very closely together, get the sort of combined stimulus needed, which will be good for the economy and thus be good for the stock market. And I think that's obviously what's going on here. We also, though, we got to put this together a little bit with, there was more COVID vaccine news at a time when we're seeing cases, hospitalizations, and deaths at highs of this whole 1-year period of this pandemic. So you have those competing factors. I think the market usually has been taking the vaccine news over the surge news because the thought is it's going to peak sooner or later. But there is a lot of trepidation when you look at some of the data about how Americans are traveling and how a lot of Americans feel about gatherings, about mitigation attempts, that we are going to see a big spike after the Thanksgiving holiday. And then the real issue here is, what do those mitigation attempts mean for the economy? We've seen lots of places putting mask mandates in and social distancing mandates. And in California, they closed restaurants and bars, that sort of thing. So are we just kind of pushing out the kind of end of the pandemic? And this is really important, does this few-week lag in the transition really affect the ability to get these vaccines out to a mass commercial population in the coming year?
Yeah, a lot to unravel there. And you might have noticed I had my hand up because when you asked that rhetorical question, I was
Ooh.
ready to pounce. Like when I was in college, if I knew the answer, I would immediately throw my hand up, and the teacher would never call on me, unfortunately, story of my life, and you didn't either. But I think, listen, your points are all spot on, and the market is clearly looking past anything that can transpire between now and effectively May or June of next year. And it's saying, you know what, we know it's going to be dicey. We know it's going to be bad, but you know what? It's okay because by the summer, everything's going to be not only the way it was, potentially better than it was, because that's what effectively, if you look at the valuations of this market, that's exactly what it's telling you. And I find that to be fascinating because valuations do matter at a certain point. And in my opinion, again, not getting all wonky stock market, but this is a market that's now built on a very unsturdy foundation. And it's like that, what's that game, Jenga, when you put all the different blocks together? Jenga.
Well, so let's
I
just
the
break that
original
down.
version, but that's what it feels like to me.
Yeah, let's break that down for a second. So your point is that we still have, millions and millions of Americans unemployed year over year from this point last year, and we don't have that fiscal stimulus, and we have mitigation attempts going on with the virus. We have a lot of school from home, work from home, that sort of thing. So I guess the point is that without the fiscal stimulus, we really run the risk of pushing out the recovery that the market is pricing in right now. That's really important. I saw that Goldman Sachs, their Q1 GDP, they just lowered it to a negative 1%. Yeah. Are we about to have a double dip recession? But let's bring it back to the market. I think that's what the people are here for. We have a couple charts, the S&P 500. Let's start with this 1 year because we had been keying on as a really key level. That 3,400 is just below that. That was the February high before the 35% crash in February, March. Here we are now. We bounced off of that 3,200 level. 3,400 seems like good support. That was the prior high that I just mentioned. How are you looking at this 1 year chart and this recent consolidation in and around 3,600? Is this setting up to be a massive launch pad for a big move into year end and obviously a follow through into the new year?
A lot of people would suggest exactly that. I mean, we've talked to Tom Lee. We've had a number of people on the show, Tony Dwyer. I mean, the list is pretty long in terms of people that think that's exactly what's going to take place. That, we've been building this base somewhere between 3,550 and 3,600 in the S&P 500. And the next leg is significantly higher from here. We had Louise Yamada on Fast Money a couple of weeks ago, and she suggested somewhat the opposite. But as I say, that what makes markets. I'm shocked that we find ourselves on this Tuesday before Thanksgiving at the levels that we are. But I think to your point earlier, the market says Janet Yellen's in, stimulus is coming, we'll look past everything, and off we go. But real quickly, you mentioned something about a double dip recession. And, people ask me all the time off camera, are we in a recession? And I would submit right now, Dan, that there are different people that are in every element of the business cycle. For a lot of people, things have never been better. For a lot of people, nothing's really changed. I think for a certain part of our population, there's clearly a recession. But I'm here to tell you, and I think you sort of spoke to it, for 25 to 30 million people in this country, and maybe their immediate families, this is a depression. And I will stand by that because that's exactly what they're seeing. So I think for the first time in history, maybe, you've seen all four different levels of the cycle playing out at the same time. And I don't know how that plays itself out in terms of the broader market. But right now, the market is clearly focused on one thing, stimulus and the bridge to the other side in June of next year, effectively. So to answer your question, I mean, look, as much as I think we're going to retest that 3,400 level, and I've been sort of steadfast in that view, at a certain point, you can't sort of buck the trend. And right now, it's all systems go, Dan.
Yeah, I mean, listen, we're going to, I don't mean to sound so glib about that. I mean, we'll be at 3,400 and then talking about retesting that September, October double bottom just above 3,200 very soon. That's just how markets work here. We're just discounting so much. I'll just mention this about all that stimulus, especially on the monetary side. Obviously the Fed hit rates really hard, took them down to zero. They instituted all of these newfangled kind of plans to kind of keep the economy going, avoid a huge credit crisis, that sort of thing. This was in the spring, in the throes of the pandemic. And listen, all the power to them. They did what they probably needed to do. But at the end of the day, we're sitting here looking at risk assets in markets, and really what they've done is just buoy risk assets. To your point about the K-shaped recovery, it's really benefited those people on the upper right of the K. I just want to talk about this 5-year S&P chart right here, because this is one, as we kind of bang up against the prior highs that we're not far away from, we get to a point where this is, we're kind of hitting some resistance here. You know what I mean? A long-term resistance. If you kind of draw a line from the 2018 high, or the early 2018 high, the 2019 high, and then these two highs that we've had here. So let's just keep an eye on how the S&P acts towards that. Let's just pivot to the NASDAQ, the NDX, the NASDAQ 100 guy, because, let's go. Tell me about what you think of this rotation that we've seen. The mega cap tech stocks, which happen to be the 5 biggest in the S&P 500, but obviously the 5 biggest in the NASDAQ 100, they make up 45% of the NASDAQ 100, about 24% of the S&P 500. What is it telling you that the NDX has not confirmed or made a new high from that September 2nd high?
What's interesting, and you've said this on our show, is that this is actually a pretty bullish thing for markets in general. The fact that you're seeing finally a rotation out of basically the 5 high flyers that have taken us to the levels that we've seen, people sort of circling out of those and putting their money into these cyclical names and some of the other stocks that we talk about all the time. So you could make an argument that that's really encouraging, as long as the as long as the NASDAQ doesn't effectively crash and test the levels we saw back in September, things are going to be okay. But you mentioned something that's really interesting. 5 of these stocks, give or take, are 24% or so, I think that's correct, to the S&P 500. And that at a certain point is going to be a little bit dicey as well, because if these stocks start to roll over, and you're seeing it to a certain extent in names like Apple and a little bit in Microsoft, obviously Amazon. Yeah. I mean, things can get dicey very quickly, and quickly, not to play stock market, but, you mentioned Facebook, and if for whatever reason, and Kara Swisher has spoken about this and written about this, if Facebook falls under the auspices of ESG investing, I mean, that could be extraordinarily deleterious for that stock as well. So the NASDAQ, to me, is clearly under pressure. You had that high back in August. You tried it again. You made a third attempt at it, seemingly failed. I think that uptrend line that you drew from September is clearly in play, and that's going to probably come in the form of about 11,200 or thereabouts, and I think that's where we test on the downside for the NASDAQ, Dan.
Yeah, I just want to add one other name that's kind of sneaking up on the S&P 500 here. It's obviously a big component of the NASDAQ, but Tesla this morning, as we speak, it's Wednesday, Tuesday, shortly after the opening, just crossed $500 billion mark in market cap. That would make it the 6th largest stock in the S&P 500, right behind Berkshire Hathaway at $545 billion. That is going into the S&P. It's the largest add ever. That stock has obviously been up tremendously. So when you talk about the potential for the NASDAQ mega cap names to really weigh on the broad market in general, Tesla is going to be right up there, given the outperformance and given this kind of just this rush in by indexers. All right, let's hit the Russell 2000. This is one that really speaks to, the kind of just the ramp. It's up like 20% in this month alone, right? Since the lows of November, and widely perceived to be, a beneficiary of whatever added infrastructure spending, fiscal stimulus, that sort of thing. This is a part of the economy that had been hit kind of hard, small cap sort of stocks. I also think it's kind of reflective, though, or was reflective when it was underperforming, of what's going on in a lot of industries that are not subject to any more aid. And that would be some areas of hospitality, like the restaurants and stuff that employ millions of workers, right? So to me, what is the Russell 2000's ramp and new high telling you about just the kind of the broadening out of this rally, post-election optimism about further fiscal stimulus, infrastructure spending, and obviously continued easy monetary policy?
Yeah, the Russell was the last piece of this puzzle for the bulls, and it's obviously playing itself out. It's basically up 100%, give or take, since the March low, which is pretty remarkable if you think about it. And I look at this and I say to myself, well, the Russell is telling me, or at least it's seemingly telling me, that the market believes the economy is improving, and the economy improving should be negative for bonds or bullish for rates. In other words, rates should grind higher, and everything should be sort of on autopilot. I think rates are going higher. But I don't think rates are going higher because the economy is improving. I think there are facets of the economy that seem to be doing better. But, you said it. I mean, there's still some serious headwinds for the economy. And I think the market's looking past a lot of those things. But this tells me that this chart specifically tells me that there's a belief that rates are going to go higher. There's going to belief that sort of the stimulus is coming, and maybe that is true. And there's a belief that it doesn't matter what happens from here to June, there is some bridge to the other side. I think the market is clearly getting ahead of itself, but the Russell is a beneficiary of this. And again, you have to wonder at what point does the market say, hey, wait a second, valuations are stretched. I mean, things might be getting better, but what are we pricing in at this point? Because you look at this, the Russell basically at an all-time high, and that's telling you effectively the economy's, the small business in this country has never been better. And that's clearly far from the truth, Dan.
Yeah, I just say this, that, if you're bullish on a recovery and you see further stimulus and you see the potential of these vaccines, inoculating our population at some point mid part of this year, and you buy the Russell 2000 up 25% in a month at new all-time highs, I'd say to you, be careful here. You better be prepared to kind of average in, because this is going to be a longer slog than we think. I look at this chart, it's a multi-year chart for a year, and I see that 2018 high, I see that 2019 high somewhere above 1700 or so. And I think that's a level that you probably would look to add into this, playing for a breakout in 2021. I just worry about all these indices, and we're going to pivot away from the US stock market in a second, but I just worry that any gains that we have between now and the end of the year could be a pull forward of some performance next year. So, I'm just saying, curb your enthusiasm a little bit. Look to buy whatever it is you're looking to buy that just broke out on a pullback to its breakout level. That's usually a pretty consistent way to buy breakouts, is just not buy runaway breakouts, but buy them when they retest the breakout level, because that often happens.
And quickly, before we bring in Peter Hanks, something just to sort of think about as well. President Trump talked about the stock market being a report card for his administration. That's back in 2016. And basically, in large part, that report card graded pretty well. He also said, and a number of times, I'm just sort of repeating and I'm paraphrasing, that if Joe Biden were to be elected president, that your beautiful 401ks would crash and we'd be in a depression. So I look at this, and I'm just thinking this through the prism of what's sort of known out there. President Trump, like many politicians, like many people in the public world, he has a huge ego. And now that he is, again, seemingly conceded, I again say seemingly because I don't think anything is etched in stone yet, but he watches, on the back of a concession speech, this market rip to the upside, effectively making all-time highs. Losing an election is a big ego blow, but losing the election and watching the market go higher on the back of it is sort of a double whammy. And just, again, not being political here, but just reading the tea leaves, at a certain point, that's not going to fly very well. And I think you saw, Dan, in my opinion, hints of that in some of the comments that Wilbur Ross made a week and a half or so ago, when seemingly out of nowhere, somebody who you haven't heard from brought up the fact that, we have these huge debts and huge deficits. And I said on the air that night, where is this coming from? But I think it's coming from a place to try to sort of throw some cold water on this market rally. Again, just something to think about as we move forward into January. With that, Dan, we mentioned we have Peter Hanks, a strategist from Daily FX. We want to bring Peter on. Peter, welcome to the Macro Setup with Dan Nathan and Guy Adami. How are you, Peter?
Hey, thanks for having me. I'm doing great.
So, Pete, we want to sort of talk to you. Obviously, I know you heard the conversation we were having, but you're obviously, your expertise is in currencies. And I think the first thing that you heard what Dan and I were saying, but how does this sort of play out in the context of the United States dollar? And we have a chart that we're going to throw up now. Is that correct, Dan?
Yeah, we have two charts here. We have a year to date and we have a 5 year. And I know there's some levels that you're keying on here on the near term, but I think it's also important to go back and look at the kind of 5 year, because a lot has gone on in that period in global currencies. But yeah, give us your take in that framework of just kind of the administration, the virus spread, the vaccine, and what's going on in some of the other regions. That as far as the Dixie, we know that about half of that is the euro against it. So give us your views here, man.
Yeah, absolutely. So a lot of what was just discussed, talking about infrastructure, Janet Yellen being the Treasury Secretary, all of that looking like it's going to feed into a stronger economy. I think it would be good in general for the American people. Now, that will translate maybe to some stock gains here. However, one area that I think might be hurt from all this is going to be the dollar basket. Looking here, we've seen a pretty consistent decline starting from really the back end of the surge in March when we had some of that safe haven demand. Ever since then, been a pretty consistent pullback. Now we're standing along that longer term support around 92. And that's when, we're seeing the Russell breakout. We're seeing some of these equity markets hint that they might continue higher. On the flip side, it looks to me like the dollar basket here is hinting that further losses might be in store. So that's kind of how I see it here playing out on the dollar basket. Many of the same themes having similar effects here, just, inverse.
So, Peter, my question to you real quick is, by the way, I happen to agree with you. I think the dollar is going to be under pressure. I know Citi put in that a couple of weeks ago that they see a potential 20% decline in the U.S. dollar for 2021, and I sort of am in that camp as well. But is this an environment where the U.S. dollar can go lower while rates go higher? Because that, to me, is a sort of a dangerous brew. Is that something you look at?
Yeah, I think it's possible. I don't look at it too closely. I do think it's important. As you said, though, especially with the dollar basket, the euro is such a heavily weighted portion of the dollar index. So it really seems like the global trend has been lower rates for longer here. Europe and the ECB are discussing, pushing even deeper into negative territory, perhaps. That's been something that the Fed has been very unwilling to discuss. So I do think rates are potentially headed higher, and I still think that because of Europe's willingness to maybe press a little bit lower, the dollar can fall while rates climb.
All right, let's look at this chart right here, Peter. This is let's go back to the 1 year for a second here, because I drew a downtrend line from that March high, that spike. I connected it to the May. I connected it to the September high. October, we saw the breakout of that downtrend fairly significant, but then we've kind of fallen back here from above 94 to 92. And you look at 92 from the closing level, that is really kind of the line in the sand on a near-term basis. If it were to kind of hold here at 92, though, above that downtrend, that's fairly bullish. And you can see a quick move possibly back towards 94. And I would also add that it seems to be a building consensus that the dollar is going lower near term, and especially when you see some of these major banks put out these forecasts. So on a very near-term basis, you think we get a break here of both the near-term support and the long-term downtrend, and then we will look at the longer-term chart, the multi-year chart, because that's the one which gets you to that Citibank sort of outlook for 2021.
Yeah, I think it's a matter of risk and reward here from a trader's perspective. So if we do hang around the territory that we've been resting in, a pop up to 94 is completely within reason in the shorter to medium term here. And I think if we do get a little bit of that, it could make for a potentially more attractive entry point for some short exposure here over the longer term. And if we do go up to 94, there's some resistance there that we're working with. The early November high, the late September high, going to be two early levels. And then on the flip side, when we start talking about support, if 92 is broken, there's quite a lot of room underneath current prices for maybe some of those gains to start accelerating if we do head lower.
And I think that manifests itself in that 3 year. Yeah. And real quick, Dan, in terms of trading this, and this is just my opinion, but you can make an argument that you're sort of in no man's land here in terms of the dollar. To me, if you do have a bearish thesis, which I think obviously I have, and I think Peter has as well, what you're doing at this point here is wait for a potential move up to 94, that blow off top type of situation, and then look for an entry point to get short, or wait for a close below 91.5, where I think things really accelerate to the downside. And you can make an argument that you don't really need to do anything here. You're sort of in no man's land. So I think that's one way to trade it, folks. if you're sort of looking for a bearish thesis, a way to trade the US dollar. But anyway, in terms of this 3-year chart, I think it sort of illustrates exactly what Peter was just saying. Below 91.5, things can get really dicey very quickly, Dan.
Yeah, I was just going to say that is a great way that you two of you guys kind of wrap that up. It's a hard press here. It looks like an easy press at 92, like you shorted here, and we're going to have a nice clean break, and then you're just going to be going down into that kind of abyss that brings you back into 88 or so. But if you were to make a lower high on a little bit of a bounce off the support where sentiment is so negative, to Peter's point, I think that sets up as a really good spot to kind of lay out shorts if you're bearish. Let's move to gold. Obviously, fairly related here on a lot of different levels. I think the breakdown over the last 2 days. I'll let Peter speak to his year-to-date chart here, and then we also have a 5-year that we'll get to after that. So Peter, we obviously have a fairly consistent downtrend from the July highs here, a series of lower highs, a series of lower lows. We just broke. It really kind of interesting to me, though, a lot of the pundit class are still very bullish on gold, although the charts have been bad for the last few months. What's your take on gold right here?
Yeah, it is interesting because I'm very much in the same camp. There's no denying price has kind of consolidated and retreated over the last few months. But the fundamental side still is pretty attractive in my view. Again, very much to so many of the issues that are harming the dollar or potentially harming the dollar. Some of those same issues, a weaker dollar, inflation hopes, inflation concerns, going to feed into the bullish side for the gold argument as a, fiat alternative, hedge against inflation, things of that nature. So I'm very confident in the fundamental side. I really do. I'm encouraged by the backdrop. However, on the technical side, especially as you mentioned early this week, we're getting a pretty significant breakdown here. And my line in the sand was 1800, and we're dancing above that right now. So it's getting a little risky. I think up until this point, you could make the argument that this pullback or this decline over the last few months was sort of a falling wedge as consolidation before, staging the next move higher. That's how I was viewing it. But 1800 around this area, once we start to touch some of the May highs even from this year, that's when I think the argument might translate to further downside, lower over the next couple months. So yeah. Very interesting point here on the gold chart.
No question about it. Look, I mean, I in terms of gold, I was right for a while into the summer, but obviously since the middle of July, things have been dicey, and it's hard to listen. I remain bullish in gold. I see all the reasons to be long gold. I will tell you the reasons why I think it's lower is the fact that the dollar hasn't collapsed. You saw a little bit of bid to the dollar, and the fact that the equity markets have rallied as much as they have. Oh, and by the way, Bitcoin is at levels we haven't seen in 3 years. And oh, by the way, all sort of the headwinds and some of the concerns that we talked about at the top of the show seems to have been somewhat assuaged. So, we'll see. I still think that there's the fundamental reasons to be long gold have not diminished. If anything, they've gotten better. But then you have to say to yourself, maybe 1750 or what was sort of the May high, that's sort of going to be the support level. And maybe that's where we wash out to. We also have a longer term chart of gold that we want to pull up real quick just to take a look and eyeball it if you can. And again, you still seem to be in this significant uptrend, but, there's a lot of room to the downside and still remain in this uptrend. And it's going to get pretty painful pretty quick. So, 1750 is my line in the sand. Peters is 1800. As they say, that's what makes markets. But you have to look to that uptrend line that Dan drew as long-term support. But the next chart we want to get to real quick is the bond market, because all these things are sort of part and parcel. And here we are at sort of this, 87, 88 basis points. So we talked earlier, Peter, about your views and rates. But if you look at this chart, what is it telling you? Where do you see rates going?
Yeah, I think here on the rates chart, the trend is higher. We'll have to see if those November highs and the June highs could be taken out. If they are, then I think the March high is going to be the next area of resistance. But again, it's kind of a slow churn here. And as far as trades go, not really looking to get into this myself. I think there are more attractive markets out there, but I'm a believer in a gradual churn higher here.
Yeah, so interesting on the yield front. I mean, this goes back to also the idea that Janet Yellen, the woman who ended ZIRP back in 2015 or so, is now going to be in charge of the Treasury, or at some point early in the new year. Obviously, paired up with Jerome Powell, who also found out what it feels like to start to raise rates off of a fairly low bound on a historical basis. So, that will be one. I know Guy says all the time here, careful what you wish for when everyone's on one side. Keep reiterating how rates are going to stay low for so long, and they keep moving the goalposts. You get the sort of creep that we're having right there. I just keep an eye on that uptrend. As long as it holds that, but maybe stays below 1%, you're going to have this tension building, and that could make for a really explosive trade at some point as we get into the new year. Peter, we talked in the beginning, and I know you have a lot to say in this, of the rotation that we've seen, into more cyclical sort of sectors out of mega cap growth that have performed so well. What is your take on some of these areas like energy? We have an XLE chart. We know that XLE, half of it, Guy, is this right? Is Exxon, Chevron, PSX, and Schlumberger, that sort of thing, a handful of names here. But we've seen a massive move this month in the XLE. How are you thinking about positioning in these sort of cyclical sectors that really underperformed and have really overperformed just in the last month?
Yeah, absolutely right. The move in energy this month has been really remarkable, outpacing the S&P 500 by a pretty significant margin. And the reasons behind the rotation, I think, are very logical. And after all the froth, if you will, not my favorite term, but after all the froth in some of these work from home stocks and the big tech names, it does seem logical that we're getting a little bit of buying interest in these sectors that have just been pressured for so long, now that there's a light at the end of the tunnel with a potential COVID vaccine. However, I think one of the things to keep in mind is that energy, especially energy, wasn't necessarily a super strong sector even prior to COVID. Yeah. Always over the last couple years, well, I suppose in the beginning of 2020, we did have some tensions in the Middle East that were giving rise to an increase in crude prices. But for me, it's a question of, okay, well, a COVID vaccine is somewhere down the line. We don't know how long it will be until we get enough uptake in the public to reach herd immunity or anything like that.
Yep.
So this rotation seems like a little bit too much too soon for me. And I'm generally not a fan of energy. I do think there are other ways to play it. Maybe in a currency pair that could pan out better, though.
Yeah, we want to talk about that currency pair, but just remember this XLE chart, folks. Just take a visual of this. And now, real quick, go to the XLF chart, which we have. So if you want to see what I think is going to happen, I think you're going to see what's happened here in the XLF happen in the XLE. And you go back and look at sort of that June island that we've taken out now. I think you're going to see similar in the XLE. So just bear that in mind as we move forward into December. So real quickly, Peter, you mentioned the crosses, and I think the one that sort of sticks out is the dollar Canada, and we have a chart here. So maybe you can speak to what you think is going on in the U.S. dollar Canada chart.
Yeah, so very briefly, Canadian economy shares a positive correlation with crude oil prices. So generally, when crude oil increases in price, the Canadian dollar is going to benefit from that, and therefore the U.S. dollar versus the Canadian dollar currency pair is going to fall. That's a super brief version here. So now that we're seeing a little bit of a resurgence in energy, and crude oil is, running into resistance, take that in mind, and then add in some potential for dollar weakness, as we discussed on a few charts ago. And the pair we're looking at here, running up against pretty long-term support just south of 130, looks to me like it's a potential breakout trade. As Guy talked to the XLE potential breakout, this is probably how I would play it. I do think a continuation of some bullishness in the energy sector would be felt here in this currency pair, and you have the added benefit of some of potential dollar weakness, just adding another tailwind. So looking for a break beneath 130 here for essentially just opening the door to further losses.
Right, and as you just speak, we also have a 5-year chart just to sort of illustrate what Peter is talking about in terms of the support level and what can happen if and when we break that support. And you see the levels that we were traded at in 2017. And I know Dan has some questions about the euro, but Peter, as we get in the euro, we want to pull up a euro US dollar chart, and maybe you can speak to that as well.
Yeah, I think the euro is in a very interesting spot. Just earlier this week, we had PMI data from both the Eurozone and the United States. So the United States data generally a little bit more encouraging than what we saw in Europe. We'll have to see how that plays out over the coming weeks and months. Obviously, European countries are in various stages of coronavirus lockdowns as well. So the data that we're getting now might not necessarily reflect the economy on the ground. So there's a lot of questions. Beyond that, from a price standpoint, I think a lot of those questions are reflected in the indecision that we've seen since August, just kind of fluctuating between 116 and 120. So I know that's a fairly large range, and because it is, it might lend itself to range trading opportunities. Over the longer term, it's going to be difficult for the dollar basket to get a lot of ground without some weakness here from the euro. So I think once we start bucking one of the lower or upper bounds of this range that we've seen over the last few months, that's when you can start to formulate, okay, maybe we're looking at a breakout here or a breakdown. I don't think fundamentally there's a super strong case at this point in time to say, okay, we're headed lower here or vice versa.
And just so you folks can see, just so you have a visual, we have a 5-year euro chart as well, just so you can understand, the levels that, the potential levels on breakouts or breakdowns. So Dan, I know you want to throw it to the pound. If maybe you can ask some questions to Peter about that.
Yeah, I would just make one other point. So check out, on Peter's levels as far as the euro US dollar here. I know a lot of you guys trade very short term. That 118 looks like pretty decent support, especially this month. And then, above that 120, that prior high, you have a pretty significant breakout. Take a ruler and to a 10-year chart, and you take the 2011 high, you see a very significant downtrend that's been in place. And this recent consolidation, maybe you call it a bull flag, is right below that downtrend. So if everything that Peter thinks about what could happen with the US dollar and then some of the things that are going on in the Eurozone that would be positive for the euro, you could be on the cusp of a pretty significant breakout. And that 2011 high and the 2010 high are somewhere up just below 150 or so, for whatever that's worth. Now, obviously, the pound, real quickly, we're just going to hit this. This is the last one as far as the crosses. And I know you have a ratio chart in the NDX I think is really interesting that we want to kind of close out with. But this British pound, you look at the 5-year and you look at that resistance level, at 135 that it's been rejected at in 2018, 2019, 2020. That seems like a big level. And we know that some of the dynamics going on in the Eurozone are fairly similar to what's going on in the United Kingdom. But we also know that the United Kingdom is trying to negotiate this Brexit trade deal, which would be important and obviously positive for the pound. Do you want to speak to the technicals of this chart, Peter?
Yeah, absolutely. So very, very important level there at 135. You touched on all the rejections that we've had in the past, and I think it goes back to Brexit, this Brexit debacle that has been just a cloud over markets in the UK for so long. We've seen, the FTSE 100 be a laggard as well among European indices. So it seems like there's some light at the end of the tunnel here before the end of the year deadline, and I think that's being priced in, maybe rightfully so here. Again, it's a matter of, is this time going to be different? I know that's a popular, joke or meme or whatever you want to call it. This time it's different. To trade this, I would prefer to see a break above 135, maybe a few consecutive daily closes up there, just to really solidify, okay, we made it to the apex of the mountain. This time it actually is different. If we reach that level, I think it's breakout territory, absolutely. And then you can set your sights much higher, maybe some of those 2017, 2018 highs, just shy of 145. The support, early support coming in, around the lows of the third quarter of this year, probably around 127, 127.5, somewhere in there. Again, if we start to buck up against that level there, it could be a sign that Brexit might not be going as well as was previously suspected, and then more weakness could be in the cards. I do favor the long side here, though.
Yeah, I do too. I don't think you have to even wait for, I think you probably position ahead of the headlines, because if you get that headline about a deal, and I think that, part of maybe, think about this. Trump came in 2016 on a wave of kind of nationalistic sort of fervor. That was what went on with Brexit. This could be the undoing of that. We might see, greater cooperation with some of our allies on this sort of thing. So that thing breaking out. Let's go full circle here, bring you back to the equity markets, because that would really, let's give you the final quick word on this NDX to Dow Jones ratio that you sent us. And we think it's an interesting chart. We'll leave our viewers with a little stock market, kind of ratio action here. And then Guy will take us out.
Yeah. So essentially here with the NASDAQ 100 to the Dow Jones ratio, I kind of use it as a proxy, a rough proxy for growth to value. So the big conversation over the last few weeks now has been this rotation from the work from home stocks, the Pelotons, the Zoom videos, and the Facebooks into some of these more industrials, energy, airlines, things of that nature. So to kind of get a barometer of where that rotation is and if it maybe has some more legs to it, I really like this ratio here. And you can see we're kind of at the lower range over the last 5-6 months here for growth to value. And back to some comments I had prior, it's really a question of how long is this rotation going to play out? Because over the next year or two, I think I would be much more comfortable from a growth perspective having exposure to tech rather than some of these beleaguered industries that are just recently getting their time in the limelight. I think tech was a big driver prior to COVID. I think it will be the big driver after COVID. It's just now a matter of, okay, we're getting a little bit of a shakeup in the relative valuations on the shorter term. And I think this ratio here does a very good job of shedding light on that.
Well, Peter, thank you so much for being generous with your time. We appreciate it. Obviously, folks, you can read Peter at the Daily FX. He's a strategist there. We've enjoyed speaking with you. I'm sure we'll have Peter on again. Dan, just sort of take us out. I would also submit, folks, fascinating day today, depending on when you see this video. But I do think the tell today is going to be what happens in the volatility index, which we really didn't speak of, but we're banging down towards levels that we saw back in August. 21.5 or so has been support. If you see a big update in the equity markets today and the VIX closing positive, that might be a tell in terms of where we are next week. But Dan, take us out.
Yeah, real quickly, just on the equity front, I don't love seeing this sort of crazy. I'm looking at my screens. I'm seeing things like Wells Fargo up nearly 7%. We're seeing the airlines and some of these kind of epicenter stocks, Carnival Cruise up 10%. I'm not sure what happened with the transition being certified, if that's the reason for doing it. I just, again, I worry. And I actually agree with Peter, is I think once this trade on some of these really hard hit groups, it's going to take much longer for them to come back, and their balance sheets are impaired and their business models are going to be really challenged for probably quarters, if not years. You're going to see a rotation back into mega cap tech and growth. So to me, I think you want to be too careful, or be a little careful about buying some of these names up here. And then also understanding that, a little correction in the mega cap names could be a very healthy thing, playing for another leg higher in these things. So that's my take, Guy. It's been my pleasure to be with you. Take us out, bud.
Well, first of all, I mean, I just have to comment on that. That is a great rig you got going on. The vest, the tandem vest with the gray polo shirt is a tremendous, tremendous look.
You, pal.
Listen, we have to, again, thank you, Peter Hanks, for joining us today. Peter, I think, did a great job. And I also want to thank IG, our presenting sponsor, IG US, one of the fastest growing Forex exchanges in North America. Dan, I think we have to wish all our viewers a happy Thanksgiving, but I want to wish you and your family one as well.
Thanks. Right back at you, Guy. And thanks for being with us here this week, guys.
Bye, folks.